This is a show that brings to the forefront newsmakers, entertainers, and those making a difference in our lives and in our world. Each week is a new adventure with topics ranging from the most serious and cutting edge to the most lighthearted and entertaining.
This is Taking Care of Business with Richard
Greetings,
Solomon.
everyone. Richard Solomon, Taking Care of Business. How are you? Great to have you on the show today. Okay, so we have something a little different today. We have Jake Cardwell and Yoni Novak from the CFO Squad, and we're going to talk business accounting, compliance, capitalization, all kinds of really cool things that is not necessarily discussed in any real in-depth on the radio. So without further ado, Jay, Yoni, thank you for being with us. I'll just throw this out there. What's the primary business goal of the CFO Squad? CFOsquad.com.
CFO Squad, this is Jay, and glad to be here. But the CFO Squad, we've been around for about 5 years, and I would say 70% of our clients are publicly traded. So we help our clients prepare and file their financial reports with the SEC. And the rest of our clients are private companies or wanting to be public, and we help them through that process.
All right, so let's talk a little bit about what does it mean, because we're going to do a little bit of 101. We all know that there's different exchanges out there. There's the Chicago Mercantile Exchange, there's the New York Stock Exchange, there's the American Exchange, there's all kinds of exchanges. Then when you watch TV, there's the FTSE, and there's the NASDAQ, and there's
OTC markets.
Yeah, there's all this stuff.
Yeah.
Some of it popularized by Maria Bartiromo. One of the Ramones sang a song about her. It's kind of interesting how that connection. So when you talk about publicly traded companies, which exchanges are you talking about? And more importantly, if you could start with this, what is the difference between all these different exchanges?
Well, most of our clients are on the OTC, but we're having a lot of clients move up and have a few both on the American Exchange as well as NASDAQ, only because some of the institutional investors that are out there, they no longer want to invest in the smaller cap OTC markets. But most companies starting out, the only place that they can really go into is into the OTC markets, and I would say there's thousands and thousands and thousands of public companies on the OTC. But eventually, as companies get bigger and they qualify and they have more investors and more revenues, and there's all sorts of various rules on how to qualify, one sort of moves up either to NASDAQ or to the New York Stock Exchange or the American Exchange. And there's competition, sort of between some of those exchanges in order to get certain types of investors and certain types of companies.
Now, did they all have opening and closing bells? No, just I got to make this fun for all the people out there. What is the difference between the types of stock that are in these different? Like, I know that you say that they're tiers, but what makes you eligible to be, like, we all know that the Fortune 100 are sort of either in the NASDAQ or the New York Stock Exchange. I know that NASDAQ tends to have more tech in it, but who decides what's on what exchange, and then how do you go from one exchange to another? As you either grow or market forces make it a little different of a reality.
Well, each exchange has their own rules. And some you have to be able to be traded at a certain price for so many days to qualify, or you have to have so much in equity in order to qualify. They have different entry platforms to become on that exchange, and one normally enters into a dialogue either with NASDAQ or with the OTC or the New York Stock Exchange, and they have people there that help working with new potential companies that want to go on those exchanges to make sure that they're qualified, make sure that they're following all their rules, and literally prepare to hit that opening bell and to launch your company.
All right. So let's say I'm in one of the 62 counties of New York. and I specialize in making pickles and olives. Okay, we just love pickles and olives.
Yeah.
All right, and we're great at it. We make them in the bathtub, and we got the mason jars, and we heat them up, and whatever we do a whole big thing. And I go to you. I want to go public. Now you're going to be serious with me, even though you're like, bathtub.
Right. Yeah.
Because maybe I have a big bathtub and the trucks keep rolling in and out. So what is the analysis or the questions you're going to ask me? Just, because I'm going to say to you, I want to go public. What are you going to ask me? Do I even know what it is to go public? What are the benefits that I'm looking for? What are you going to ask me?
Well, I'll let Yoni go ahead and answer one here. But go ahead, Yoni. I'm sorry.
Sure. Yeah, hi. Nice to be on the show. Thanks for having me.
That's Yoni Novak, and welcome to Taking Care of Business.
Thank you.
Talk a little louder, please.
So the real question always comes down to, when a client comes to us say they want to go public, the question is why, right? So and usually for most companies, the answer is liquidity, right? They need some source of financing. So there are lots of ways that you can get financing. Some are easier than others. From a private company perspective, if you want to get equity financing, then there's private equity. Once you pass the seed round, then you start going to more institutional investors. So then looking for more serious money in terms of dollar amount. Then you go to an institutional investor and go for private equity. But some companies choose, whether it's because of market conditions or whether in terms of valuation, that they think that they can get better financing. And it's not just they think that, there's bankers out there and a lot of professionals that are working around to try to help them make the right decision to say where is their best bang for their buck in terms of, access to capital and to be able to really grow their business to the next level.
All right. So in my pickle and olive factory, I'm doing okay, but I have employees. I got trucks. I got I probably need to buy a bigger warehouse factory. I need money for that. What would you say my options are as far as giving me the most control over my destiny? When you have to go public, there's a lot of. I've heard you guys talk in other venues, and you talk about how to have a lot of transparency. That's the big word I heard. Transparency. You have to open your books. You have to show everything. Maybe people are a little shy about some of the things because maybe they aren't really that profitable. They've got maybe they have. Let's say my pickle sales are $2 million, but my cost of goods and development is like $1.9 million. So I'm only netting $100,000 at the end of the day. And after taxes, what do you got? $63,000 left. Maybe that's not the most profitable enterprise. What do you advise the person who owns the business who's looking to go public about the reality of numbers?
I think some companies have to ask that question: is there a reason why I should be public, or sometimes why I shouldn't be public? Because there's some companies that it's expensive to be a public company, and the people that you have to hire and go to that next level are a lot of overheads that some companies just aren't prepared, to pay. But the other thing is also, in our business, we're all about helping companies prepare their financial statements so that they can, be a public company and they can be audited. And I would say the first question that we do sometimes when we go into a client is, one, can you be audited? There's a lot of companies, I want to be a public company, but they're not prepared to be audited. They're not prepared for someone to go back in their books 2 years or older and to try to, account for all of those things. They were running their business. They were making money, but they didn't keep their records. And we've got plenty of horror stories of some clients that they just don't have their records, and they cannot be a public company if they can't keep their records straight.
Let's hear a couple of words. Let's say, for example, in my imaginary pickle factory, and if you saw pictures of me, I spent $100,000 on hair treatments. maybe that's a personal expense, and it has to be sort of dealt with, or what do you have to do? Give the money back and then try to clean it up somehow, or do you have to just wait 2 more years and phase that out? Like how would you recommend?
We look at both options.
Let me tell you a great story that really kind of brings home the point which H just kind of mentioned. So we had a client came to us. They were advised through bankers and through their board of directors, friends and family that have been through the process, times in the past, that their best course of action was to go public and to bring their company to the next level. And it wasn't a pickle company, but it was similar in the sense that they had inventory, right? Just like you had pickles, so you have lots of cucumbers, and that you are waiting to be pickled and sell. So for this company, they had that inventory. And one of the big challenges in auditing financial statements historically, when it's not at the time, is when you have inventory on your balance sheet and you need to prove out to the auditors that we had inventory of this quantity of these items at that time. So that's always a challenge. Kind of whenever we get a client that sees that has inventory, it says they want to go do an audit from the historically, that's kind of one always thing that we bring up. Essentially, they came to us and they said, we want to do this. We said this is going to be a challenge, especially their books and records were not in the best shape, let's just put it that way. And particularly that in terms of their inventory, they did not have a cohesive inventory system. We spent months and months and months to get this through an audit. There were definitely times late at night I'm like, this is not happening. There is no way that we're going to be able to gather up all this piece of information and prove out the necessary requirements from an audit perspective to get this through audit. It took, I think the original project, we thought it would be from start to finish. It would take let's say 2.5 months, something like that, and ended up taking 9 months. We ended up getting it through, but it was just incredibly difficult. And that's kind of just proves the point of what we love to hear is clients that come to us that say, I want to do something in the future, meaning I want to plan now so that I could prep and be ready into position that I want to do a transaction in the future, whether it's sell my company, go public, raise money, whatever it may be, then say, I want to plan now for the future.
And we've had those clients that have come to us. It's like, my banker, he wants to take me public this fall, and they're calling us July 1st, and they've never been audited. We had one, just a short war story, a client that in that situation said they're clean, they're debt-free, they don't have any big revenues right now. They want to go public and then start their operations later. So we thought it was a relatively simple exercise. And we sort of says, okay, you're debt free. Yeah, I converted all my debt to equity. I gave them stock and they converted those instruments. And we look under the hood and we do things before it gets to the auditors. So you're not wasting time with auditors. And we says, can we see all these conversion documents where you took the debt instrument and they signed off and they converted it to shares of stock in the company? And it's just oh, no, it's all here on a spreadsheet. No, we need to see the actual legal agreements. Oh, we tossed those away. We didn't keep them. I said, then you still have debt. And we had to spend weeks and months helping them through the process of recollecting all those instruments again. So that's where there's a perception about being a public company, and when you talk about transparency, sometimes it's just about keeping records and being prepared to understand what goes in to these things that we call audited financial statements. And it's not as simple, but it can be if you plan ahead, like Yoni said.
All right, so who are these auditors? Are they government auditors? Are they bank auditors? Are they auditors on behalf of investors? Who? We only have 2 minutes. Or 2.5 minutes?
Auditors
Before the
are,
break.
I mean, there's lots of audit firms. We don't audit. We help prepare for auditors, but there's big ones like Price Waterhouse and Deloitte, and then there's regional ones and there's smaller ones. They all have to be qualified, what we call a PCAOB auditor, to make sure that they are regulated for publicly traded companies. But they're the ones that they don't prepare the financial statements. They sort of kick the tires on financial statements.
And what do? Do they say, okay, so footnote 76 says that we have 5,000 jars and lids. I need to see the proof of that. Is that how
Correct.
it sort of works?
Yeah, they want to see the background information. They want to see that you have that invoice, and they test it. They don't look at every single item, but they sample, and all of the things that they sample, they want to make sure that you have. And they have their techniques of audit so that they can get through the process. But there's certain things that might be material that they're going to want to see every single thing.
Now, do they basically get the accounting software data, and then they sort of suck it into their system and then look at it? Because I can't imagine that do they do it like sort of remotely, or do they try to do it in-house at the target of the audit's place of business?
Yoni, you can answer this, but for the most part, we first get it from the client and we put it into a format that's easier for the auditors. But Yoni, you can sort of explain just a little bit on how it gets from the client to the auditor.
Yeah, sure. So, I mean, that's definitely a big part of our role. Our role is basically the liaison between the client and the auditor, and basically being that bridge, if you will. Because we've done, me, Jay, and our team around us, we really have seen this so many times, throughout our careers at CFO Squad, and many of us throughout our careers even before CFO Squad. So we've just been through countless audits, and kind of there is a systematic approach to it. So we kind of help facilitate that process. And really, there's a lot of guidelines and regulatory requirements from an auditor's perspective, but they go through exactly systematically how they have to test the transactions, what they have to test, and then it's not like every audit firm has their own set of rules. There is a general set of rules. Each audit firm might have their own flavor or style, but definitely there's a general set of rules, and then you have to conform with those set of rules, and you have to be able to provide documentation and support for all those transactions.
All right, this is Richard Solomon. I'm with the CFO Squad. We're going to take a quick break. When we get back, I'm going to ask a question about, can you go public by buying a publicly traded company? We'll be right back. And we're back. Welcome to Taking Care of Business. We're in our second segment. I have two great people who are going to talk to us about publicly traded companies and all the other good stuff. I got Jay and Yoni from the CFO Squad, CFOsquad.com. And before the break, I asked a question. And the question was, can I go public, and instead of going through the whole thing of the audit and transparency, can I just buy a publicly traded company and then sort of like merge? Is that something that people can do? Is it advisable? Under what circumstances is it generally advisable? And what do you think as it relates to different kinds of business? Is it more perfect for certain kinds of business, or not perfect for any business?
We see it, and we work on clients like that every single year. But most people, they hear all the time about the IPO of going public. But in the flip side, if you have a great company and you've been private, and you may find, I wouldn't call it a shell, but a publicly traded company that isn't that big or that active, you can do what's called the reverse acquisition, where all of your shareholders and your company buys so much in a merger, in a reverse, that you actually get to own that public company. But it really doesn't save you on the requirements to be audited. You're still, as a company, you are the register. You're the company that's going to be trading effectively once the reverse goes through, and therefore you still have to be audited. Only if you are a small private company and some very, very large public company wants to acquire you and make you part of their company can you sometimes avoid the audit. But there's really no unfortunately, way around being unaudited.
All right. Now, in terms of audits, I understand that there's financial auditing, but is there auditing for all kinds of documents and employment practices, things like, checking the payroll, making sure that everybody's in compliance with all the rules like the FLSA, the Federal Fair Labor Standards Act, making sure there's unemployment workers, unemployment insurance or workers' comp and all that stuff, and that you have the incorporation documents, and it's properly listed with the Department of State, and the biennial statements have been done, and that the all of the kinds of accounts and accounting, like let's say there's sales tax, that the sales tax has been segregated, reported, and submitted. You do all that stuff as well.
So there are different regulatory bodies. You just mentioned a lot right there.
Well, yeah, that's my job.
But there are different, right. There are different regulatory bodies that kind of oversee and govern, each one of those different type of items. What we have kept on referring to, particularly, is financial audits, and that ultimately, all public companies are under the regulatory body of the Securities Exchange Commission, the SEC, and then within the SEC there is there are a lot of requirements of disclosure, like we kept on, also saying in terms of that transparency. The point of the SEC is to make all shareholders or all potential shareholders, if they're trading the stock, should have an equal playing field and should have an insight into the company from a perspective that they should understand the numbers, they should know what the company is planning on to doing, and anytime that there is new information that comes out, then all shareholders should have that information at the same time. So one aspect of that, and that's a main focus from the CFO Squad, is the financial reporting, and just that the actual revenue and expenses and the balance sheet of the company is true and accurate, and that's where the financial statement auditors come in. There are other auditors, for example, like IRS auditors.
Yeah, I was going to jump in. I mean, there's, we have a tax division as well. So yes, there are tax audits, and people, can have a state can come in and audit your payroll and other your compliance. And normally when we look at a client, we're going to work with the attorneys to make sure that, hey, that company is current with the Secretary of State of where they're operating. But hopefully a client has other participants and other people in their company that are helping them to run payroll, and that they have a good payroll service and they're keeping it up to date, and they are filing with their Secretary of States their annual reports. But we're going to go through some of those checklists. But there's a lot of other audits that could occur if down the line, and that's where the record keeping and keeping that in order, helps that process.
All right, so let me ask you a question about publicly available document versus transparency and disclosure. So let's say, for example, there is a publicly filed lawsuit involving the company, and I don't know, it alleges all kinds of things. You know how lawsuits are. There's some kind of thing. It's always $1 million. Sometimes now it's $5 million. And I know that, there's these statements that says, whether litigation has a material impact or effect on the vitality of the company. How does that all work in your investigations? And how much do you have to disclose if something is publicly available that people can go and look for themselves versus you have to basically reprint the litigation docket sheet and lay it all out there? How does all that work?
Well, in a normal filing, there is sections where the company is disclosing pending litigation. And for the most part, it's not the full lawsuit. It's not all of the details of it. It's fairly limited or required in the financial statements to describe those. You're going to say, hey, here's the actions that are occurring, and in most cases, it may create this is what is being claimed, and that the company is going to defend it vigorously. But there's going to be enough information that if somebody wanted to, could go off and look at the court case wherever it is being filed. And if it's big companies, they're getting sued all the time, but the materiality, the size of the lawsuit compared to their overall balance sheet or operations is relatively small. They're not going to have to list all of those lawsuits. So only the ones that are material that could impact the balance sheet and the future operations or the ability for the company to continue, those are the ones that are going to be disclosed.
All right. Let's take for a moment the reverse. Let's say you're a public company and now you want to take it private. We've read about that in the news. Why does that happen, and what is different about that other than being the opposite? I almost feel like the Seinfeld question, which is, salmon's not the opposite of tuna, chicken is.
Right.
So how is it the opposite, or is it not the opposite, or is it something completely different?
It for some companies, all right, that annual cost to being a publicly traded company, to hire your SEC attorneys, to hire firms like ourselves, to do the audits, and all those other compliance rules and the special filings, that there's some new information about the company and you want to talk about it, but you got to file a public statement on that, or you got to do various other rules. Otherwise, if you don't, you could be criminally charged or other bad things could happen to you. So therefore, being a public company in some cases can put shackles on you, and you can't talk about things without other proper statements being filed. So, and certain bankers, they don't want to spend all that money. They want to take you private, and they literally will take a public company, take it private, build it back up again. They will still go through audits. They will still do many of the things that public companies will do, but they're not having to do all the reporting to the SEC. But their plan sometimes down the line is to take it back public again, and to have that exit strategy to being public. But those, what I consider $250,000 to sometimes $1 million a year in order to be just a public company, is just not something that most companies want to go through.
So how does that work, where if you're, quote, going private, how does it work, and how do you determine the price of everybody's stock that you're going to buy? How does that work in the real world?
Well, that's where the bankers come in, and in some cases, we work with a client and we work with valuation companies, and Yoni does a lot of modeling for our clients to look ahead and to say, hey, this is a great company, and in 5 years it's going to be worth X, Y, Z. And so one will look and forecast those elements. But then the bankers get involved, and they look at it to determine what they think that the market is going to play. And that's where the negotiations of those guys, and girls, come into play. So
now it seems, just from our limited conversation here, there are a lot of different actors on this stage. You got all these auditors, you got the corporate people, you got attorneys, you got regulatory authorities, I guess, on the state and national level. Am I missing anybody, or are there more? There's underwriters and
there's
actuaries.
Yoni. You might have some. I mean, one that just came off is like investor relations firms and stock transfer companies are also there as part of keeping track of things and helping tell the story of a public company. I mean, I think sometimes a public company, there's two different businesses. There's one, the normal operations of the company and making money the old-fashioned way by selling products or selling services. And then there's the business of being a public company and being able to keep your company in the line of sight of bankers and investors, and with the future being bright to the point that people want to buy and sell your stock.
And wear sunglasses. Okay.
Yes.
Like the song, I got a future so bright I need to wear sunglasses. In terms of trends, and I'm not asking for a real big forecast, but is the trend, or has the trend been more towards going public in the last 5 to 10 years? Or is it more narrow, that only some companies have gone that route because of all of the costs associated with sustaining a viable, well-run public company?
Go ahead. Yeah.
Yeah, I can answer that. So there definitely has been an uptick, in the last, I mean, obviously right now during COVID, everything's, the markets are, when COVID kicked in, the markets were, depressed. But, over the past couple of years, we've seen an uptick in terms of companies that are looking to go public and get into that, to the capital markets. Really you always have to ask yourself, and there's really, when you're in terms of equity financing, then there's pretty much two roads. It's private equity or public equity, and public equity meaning public companies. So they both play hand in hand, but a lot of companies that, we always hear about, and in the news you hear about these, mega billion-dollar companies that are going public, having an IPO, and, that happens, when they call them unicorns, that, it happens once or, a few times a year at most, a really massive IPO. But on a day-to-day basis, I mean, probably a dozen a month or so, companies are going public. So, that's obviously in the U.S. markets. So there's really been, there's always a balance between, what is right for my company, when is the proper time. But, it is definitely a viable option in terms of, a source of financing.
Now, is it the general impression that sort of technology companies are more ripe to be public companies because the need for, massive capital, especially when technology could be worldwide technology, or, when you think of things like manufacturing of computer chips, when you think of, mobile phones, things that are almost ubiquitous? Or is that just sort of the media kind of highlighting that to the exclusion of other kinds of businesses that are also well suited?
Well, I think that you see the tech stocks. I think they are obviously out there promoting themselves, but there is a need for them to be public and to have huge amounts of and access to public capital as they expand. And they're having to sometimes expand so rapidly that the only source of that capital is through the public markets. There are still some very large, private tech stocks, but you frequently will see them at least be preparing, and with the forethought that eventually they're going to be public. I mean, there can be a lot of private equity funds going into tech stocks, but they're long term are still expecting them to eventually come out and be publicly traded. That is their their exit strategy. But I think where we're also seeing, as I alluded to, I think earlier, is that some of the institutional investors and their profiles are getting a little bit more strict, so they want higher grade public stock and have these companies move off the OTC and into NASDAQ or one of the other exchanges.
Now, let's talk a little bit. We only have like a minute, so maybe let me just set up the question. We'll talk about this on the other side of the break. But there are different kinds of stock. There's common stock, there's preferred stock, there's other kinds, there's classes of stock. For people who don't really see this day to day in their business lives or even in their regular lives, I want to be able to talk a little bit about that and what are the differences between those kinds of stocks and which of those stocks are more in private businesses and which are the ones more on publicly traded companies. So with that, let me take a quick break. I have Jay and Yoni from the CFO Squad, and we'll be right back. Welcome everybody back. You are listening to Taking Care of Business with Richard Solomon. Today we are talking to the CFO Squad, although I heard they're going to change their name to the CFO Army and or Marines. We have Jay and we have Yoni, and they are true experts, and that's why we have them on. And before the break, the question was, what are all these different classes of stock, and there's preferred and voting and this and common, and what are those more geared towards private, or which one was publicly traded? So why don't we start with that as our lead-off question for part 3 of this interview?
Well, let me lead in here, and then I'll ask Yoni a question. I would say 95% of your companies, what they're trading is common stock. Some very, very large companies will have preferred stock trading, but your small companies and your medium-sized and most of your publicly traded companies, they're trading in common stock. But what's might be interesting is when the bankers start getting involved with a public company or private company and wanting to take them public, is the various other elements, how to compensate employees that may not have been fully compensated, and they're getting some extra stock. But the bankers will sometimes come along and invest or will loan money that's convertible into stock, and they have warrants and all these special provisions that without a good attorney, a lot of people won't see it happen. And Yoni can probably describe some horror stories of what's called derivatives and what it can do to someone's balance sheet.
So take it away.
Sure. Thanks, Jay. So as it often happens, especially in startup companies and the micro caps of the world, that really they need to. They're strapped for cash. They're looking for alternative financing, and that's one of the main reasons why they're drawn to being a public company in the first place. They come up with, they meaning the bankers and the investors come up with very interesting, to say the least, sources of financing, and basically with convoluted, for lack of a better term, features inside of them. So some of them will include, just to throw out a few examples, like Jay mentioned, something called a derivative, which is essentially a debt instrument that can be converted to common stock at any time, and then the price that it's converted is the 3 lowest trading days of the 10-day VWAP, which in layman's terms is basically they get some type of discount to the market whenever they want to convert it. So without getting into all the granular detail, from an accounting perspective, that really becomes a very, very complex aspect of financial reporting and of accounting of GAAP. So, there often is that layers in a whole new level of additional work from auditors, from staff like us, and as well, it also brings in valuation experts. So besides for the cost of that capital just being on the face of it, there's also all the regulatory hoops that you have to go through in order to really just account for it and to just keep up their financial reporting aspect.
And sometimes we've seen, the worst case scenario where someone says, "Oh, I'm investing $1 million in your company," or "I'm investing $5 million in your company, but I want these extra special warrants." And without going into too many details of what one could ask for, all of a sudden those warrants create another $1 million to $5 million, doubling the debt on the books, and then all of a sudden your balance sheet looks horrible, and then your stock starts going down because everyone thinks that you've got too many liabilities on your books, but it's all these derivatives, and then all of a sudden that doesn't allow you to go public into a NASDAQ or bigger market because you have too much debt. So I've seen clients spend years trying to get out from underneath it. Now, we love our bankers. All bankers, companies need them, but one always has to really read those documents very, very well. And before they sign them, we always say, do the calculations. What does this mean to your balance sheet after you sign it? It's not just getting $1 million worth of stock sold. It might mean several $1 million of debt. And it's paper debt that just sits on your books and it becomes a horrible drag for a company.
So in the 13 minutes we have left, let's hear some good war stories, some great victories, some surprises, some creative moments. Anything that comes to mind. Anything that comes to mind.
All right. So I'll tell you one that it's actually not on the public company side, but I still like the story. It was really, it was a few years ago. We were involved with the company. We originally came in as a private company, growing rapidly in the healthcare space, and we originally came in to do, help them through their first audit. They were getting more corporate-like, and they were growing as a company, and they really wanted to kind of move the the finance team in the right direction. So we kind of came in to help out. It ended up being that we really got integrated with the finance team, me personally, and a lot of my staff as well. We ended up touching basically every aspect of their company in terms of from the finance side. We ended up catching up all years and years of tax returns, doing, I think ended up being 5 or 6 years of financial audits. We helped them on from the financial due diligence process when they were going to raise private equity. They ended up raising a successful raise of $60 million, but we were involved and really integrated as part of their finance team. Ultimately, towards the end of the process, we ended up bringing in an interim CFO, Joseph Himi, our founder, who came in as the interim CFO to kind of help them through the last phase of the financing and to push them over the edge in terms of, help them through over that hump. Because really, once you go through, financial due diligence of private equity firms, firm after firm after firm, usually the, companies that are looking to raise money, they could reach out to, tens or even hundreds of firms to try to raise money, and then narrow it down to the people that are interested in that space, and then narrow it down to more as they go through the financial due diligence process. And it really just can become a big, burdensome process. So I like to kind of tell that story mainly because it just kind of shows the different facets of the CFO Squad. It's not that we're just a financial reporting company. It's really that we can help in almost every aspect. And, we grow and shrink based on demand and based on the client size and need. So, just a little insight of one client at one point in time. I like to bring that out.
Jake,
any good war stories or interesting?
Sure. I mean, I've probably got more war stories, but I have one good story here that we had, and it's still one of our clients that they had a concept for an app for a phone, for iPhone or a smartphone, and we've helped them develop their plan and forecast their model as they were developing their technology. And after a couple of years, they were going to launch around February 1st of this past year, and COVID hit, and they sort of, pulled back a little bit, and now they are launching out, and we expect them to go public this next year. So we've seen it from the infancy and just the concept, to larger companies that have the full accounting firms, but I like working with clients that take their concept and help them through the years so that they can actually be a successful company, and if they want to go public, they'll be ready to go public.
To what extent have either of you seen innovation being the engine of a company, as opposed to just doing a standard kind of thing like, I don't know, making tires, you just make them well, as opposed to making like a revolutionary tire that won't ever go flat and will give you good gas mileage or things like that, for lack of a better example.
Right. So actually, I would say most of our companies are on the innovative trend, or they are innovators. We definitely have the standard companies. They sell retail, they sell electronics and so on and so forth. But a lot of our companies are, a big handful of our companies are in the healthcare space, really doing very, very unique ideas, creating products or creating new ways of doing things. We have companies that are R&D companies, whether they're in researching from medical marijuana, or they're researching in, precancerous detection tools. So there's definitely, we see a lot of that, and that I think is the great aspect of, the public market, that there's really there's so much great entrepreneurship out there, and, the capital markets be able to get, capital and financing to these entrepreneurs and to these innovators, and that really kind of drives growth as, the economy as a whole.
Where do all these entrepreneurs come from? Because you can't, in my opinion, you can't really go to school and learn to be an entrepreneur so much as you have to have a lot of, skills that somehow bring something inside of you to the surface. I can't explain it, but you could teach me how to write a song. I can go to school for songwriting, and Beethoven and Mozart will be there, and as professors. And I'll never just write a great song or a decent song or a pathetic song. It's just not in me. So what is it? Where does the entrepreneurial fire come from, and where do you see it coming out of?
I mean, I've seen it through the years. I mean, we've, just my one client that I just described. I mean, he was in real estate and commercial real estate, and had a concept for an iPhone for something that he needed for his family, and he just sort of kept on thinking that, well, I'm not the only one who needs this, and I can't find anybody else doing it. So he was so frustrated that he couldn't download an app to solve a problem for himself that he decided to figure out how to design his own app, and just believe that there's millions of people that need the same problem solved. And I think that's where it comes from. It's just like, what frustrates you? What do you think that the world needs that that isn't being solved, or just a new, better way of doing things, that if all of a sudden, if you have or can solve that problem, and you'll be amazed that there are a lot of problems out there that haven't been solved yet. And I think that's where that innovator comes in, that sees that problem for themselves and knows instinctively that it's going to solve the problem for millions of people around the world.
Would you regard yourselves as entrepreneurs, individually as opposed to the company?
At one point, I was. I don't know if I am so much anymore.
That's honest.
Yeah.
You know,
when I was younger. Yeah.
Do you need to be?
So actually,
go,
I definitely consider myself an entrepreneur in a sense. I mean, I'm not the founder of the firm, but I've been with the firm basically since the beginning, the third employee. So, what I like to say is that there's really, we're not your father's or grandfather's accountant. There's way more that can be done now in terms of, software, in terms of automation. What I definitely like to focus on is like flip the script, as in, not the typical accountant that's sitting in the back crunching numbers through on his, on his calculator. It's, the whole world is shifting, and the accounting profession is shifting with it. So whether it's the accounting profession and also finance departments within the companies, I believe that if you don't, go with the times and, grab hold of the technology that's really out there, then you're going to be left behind. So I have a big focus on, on automation and making sure that things can be done better and faster. And really, in 2020, there's almost no reason why things should be manually entered into an accounting software. And obviously, there's going to be always a need for accountants, but I think that there's a big shift towards automation, AI, and really just using software to its fullest.
Right. So,
in my past.
Good.
Yeah, I was going to say, when I was 25, I had a much more sprite, entrepreneurial spirit. I probably still have part of that, but I apply it to my clients to try to help them find, a path forward in their own quest that they might have uncovered.
So we only have a minute and a half left. So could you tell me where you think your business will be 5 years from now and how the world will be somewhat different? Now, I'm not talking about politics or any of that stuff, but just the evolution of technology, AI, we went from the 8-track tape to the download, to streaming. Like, where do you see yourselves, and how will it be different?
Well, I mean, as a firm, we sort of are in a unique space where there are the traditional classic accounting firms out there that sort of do everything, and we are there with technology to try to fill those gaps where we expand and contract with the needs of a client, where they need extra hands, they need extra help, there's special technical accounting, and we've been growing literally almost 40% a year for several years, and we don't see an end to that, just because companies just don't need these huge accounting departments when you start adapting, like Yoni said, adding new technologies, and then you need the people there that bring those pieces together on a timely basis. So we're seeing that change, where we're there as a tool for our clients, where they don't have to have full-time staff to get everything done, and we're sort of just bridging those efforts, and we see no end to that right now.
Well, speaking of ends, we are perfectly timed, and I can't thank you enough for being on the show. It's the CFO Squad, CFOsquad.com. That was Jay and Yoni, and if you have any questions, send us an email, and we'll forward it to them. We thank you both for being here, and we thank everyone for listening. See you next time.
What?